Welcome to Rogue Trader. Please read the disclaimer and remember that prices can go down as well as up. Hello, and today I'm going to take a look at Rockhopper Exploration. Rockhopper are an oil and gas exploration company based in the Falkland Islands. They have a lot of exploration licenses around the Falklands, which you can see here, a close-up of the northern licenses, and they actually struck oil back in 2010 in the Sea Lion oil field, and Premier Oil then, in exchange for 70% of the oil rights, gave them a load of money, and they did a load of further exploration wells. And this is now a fully understood and de-risked set of oil fields that they have within their P0032 license here. So Rockhopper have the Sea Lion project all set up and ready to go. But then last year, Premier Oil, or Harbour Energy as they're now called, dropped out of the project. Now another company, Navitas, then came in, and in exchange for 65% of the oil rights, offered to give Rockhopper the cash to get the project going. But the fact is, unless this technical agreement gets signed with Navitas, and it's already about 4 months overdue, unless that happens, they're going to run out of cash in September and either go bankrupt or have to do a costly capital raise that will drop the share price considerably. So this is a very high risk stock. The other side, however, is that based on my calculations, although the market cap is only 50 million at the moment, the profits that they'll have coming in if the Navitas deal gets executed will be 1.8 billion. So there is staggering upside here, making a very exciting, high risk but high reward gamble. Before I go into the Navitas deal, it's good to take a step back and have a look at all of the operations that have been going on around the Falklands. Rockhopper were AIM listed in around 2005, and around that time there were actually a lot of small AIM listed companies who raised money to then explore these licenses around the Falklands. And it really is a fascinating tale. One of them, Falkland Oil and Gas, owned all this acreage down here in the southeast Falkland Basin. Now this basin is deep water, about 2 kilometers deep, so it's a lot more expensive to actually get all the work started. And they had very limited success and ended up getting taken over by Rockhopper, and that's how they got hold of all of these licenses here, which are low chance of success, but could be the absolute mother lode if ever they did get developed and properly explored and developed. But they're not really relevant to the current Rockhopper situation or prospects. There was another company, Desire Petroleum, who owned these prospects in yellow here, and they also got took over by Rockhopper, and they had limited oil and gas shows. So although they did have some success, it wasn't the oil strike that was needed to get the investors in, and then that ended up in Rockhopper swallowing them up to gain these exploration licenses. There's another company called Borders and Southern Petroleum, and they own a license just to the south of where Rockhopper's licenses are here. So here we see in grey the current Rockhopper licenses, and then just to the south here is the Borders and Southern Petroleum's licenses. Now they made a gas condensate discovery at their Darwin drill. It did suggest that there were significant gas fields here. They never got enough interest to get anyone to farm in or anything. And so despite that success, no one's invested in these licenses and given them the money to get the project going. And here, if we take a look at Borders and Southern Petroleum's share price, we can see that all they are now is they just hold that license, but no one has any interest in them. And so it's effectively a zombie stock. And the big worry, of course, is that Rockhopper are here somewhere now, and if their Navitas deal doesn't go ahead, you know, if you buy shares in Rockhopper, you can be ending up with a zombie stock like this. There is another company called Argos Resources, and they own this license here, you see. So here it is zoomed in, and they had obviously obviously Rockhopper were the only company that had a clear oil strike that then led to the extra investment for them to more develop and de-risk the area. But Argos, at the same time, they got some oil and gas shows, but it wasn't like a full oil strike. And they think that from their seismic data and stuff, they think that they do have these big oil fields, oil and gas fields within their license. But without the confidence that a proper oil strike gives, they weren't able to get that investment to develop those fields. And here, if you look at the Argos Resources share price, you can see again, it's now just a dead zombie stock. Rockhopper, however, did strike oil, and they used the money they got from Premier Oil, who are now called Harbour Energy, to do a load of more drills where they have clearly showed that these are low risk and well understood oil fields. And together with Premier Oil, they put together this plan where they were going to do 3 phases. So phase 1, they concentrate on the Sea Lion field, and that will bring in 250 million barrels of oil, of which Rockhopper would have got 75 million from their 30% share. And then a phase 2 where they develop the Zebedee and Ninky South fields, and then a phase 3 which is called the Isabel Elaine phase. So you can see here they've got the whole project on the shelf ready to go, but then Premier Oil just walked out of the project last year. Now Navitas then did step in. And they signed a heads of terms with Rockhopper and Harbour Energy, so that Harbour Energy would be able to divest all interests and walk out. And in the new split, Rockhopper would get 35% of the oil assets and Navitas 65% of the oil assets. This heads of terms, however, expired already, and it's going to expire again only next week. Now it could get extended again, of course, but really the next step, but we're still in a very nail-biting moment, and the next step is for the technical and finance plan to be signed. After that, Navitas will pay Rockhopper a loan to cover all their costs with 8% interest. That will then bring us to the final investment decision. After that, Navitas will pay Rockhopper an interest-free loan to cover 2/3 of the development costs, and it will take 3.5 years to get to first oil. Once you get to first oil, then Rockhopper will pay back the loan using 85% of free cash flow. According to Rockhopper's slides on this, it will cost 1.8 billion to develop the capex to first oil. But then once that happens, the value of the oil is 18.7 billion. That's for just phase 1. And from that, the profit that Rockhopper can get from that is 1.8 billion. So that's how I arrived at this massive upside, which, as you can see, is a huge multiple of their market cap. So like I say, the upside here, based on my calculation there, is staggering. Any of you who are good at the financial things and know this deal inside out yourselves, please do comment in the comments section if you think I'm wrong at that or have any comments on that. But yeah, based on the numbers I see here, if that deal goes ahead, the upside for Rockhopper just for phase 1 are staggering. And then of course, once phase 1 happens, it's so much easier to then move on to phase 2 and phase 3. So they have some Italian assets. Actually, they're just a distraction, really. They have, in their Italian assets, they have the Guendalina field. And this is actually producing 36,000 barrel of oil equivalent a year. But it's actually bringing in negligible revenues now. It's actually loss making now. So it really is just a distraction. They have the Obrima Mare resource, which the Italian government actually put a stop to. The Italian government banned all new oil developments on the coast, and this was actually illegal, and Rockhopper took them to court. And according to a presentation I saw their financial director give, they could get 50 to 200 million from that, but it was 3 years ago now since they took them to court, and they've still not seen the money. So there is uncertainty there, but obviously if that money did come in the next 6 months, that could keep them going for a year or so. And then they also have some Monte Grosso exploration rights, but again that project got put on ice because the Italian government decided to ban all future oil developments. This is the same Italian government that's currently importing oil and gas from Russia. So overall, you see mentions of their Mediterranean assets in the annual report, but it's actually now of no consequence really of the future of the company, apart from this situation where they took the Italian government to court. So it was back in 2012 when Premier Oil did the farming deal, and then Premier Oil have basically sat on this project for a decade until pulling out last year. Other bits of news are in 2019 there was the Ibrahim Mayer arbitration, which they won against the Italian government. Navitas actually entered the project in January 2020, and so now it's obviously lucky that they did, because they've been on hand to perhaps save the day. They sold their Egyptian assets in 2020, and really this looks like the situation where they're running out of money, so they're selling stuff off to survive. And of course Harbour Energy pulled out last September, and then Navitas jumped in with their offer. The chief financial officer left in December 21. So that obviously really we should look at as very negative news. The CFO leaving a highly stressed company has got to be a bad sign to take into consideration. And then in December last year, we had an update on the Ibrahim Mayer situation, where the Italian government had gone to the appeals court, but then the arbitration committee rejected the Italian government's appeal. So they should get the money for this Italian deal, but it's just a question of how long does it drag on in the courts and stuff before they do see that money. And the last news item we got from Rockhopper was that the provision of heads of terms for their deal with Navitas got extended. So it had already been extended from December through to January 31st. Now it's been extended again to 31st of March, but still several months later and still no deal going through. So still, after going in deep a bit, it's all about the money running out in 6 months' time. Will Navitas be able to raise the money and sign the technical agreement in time? If not, the company runs out of money. If it does, there's tremendous upside here. Looking at the profit and loss, and it's notable that the revenue drops in 2020, and that's because they sold off all their Egyptian assets. Otherwise, the only thing notable is this massive loss in 2020 of 223 million, and this was from impairment of exploration expenses. Now they explain it in the annual report, and basically, and really all it is that for the exploration costs that they put in to enable the Sea Lion project development, the exploration costs associated with that are listed as a asset, and what they've done is they decided to write off all the exploration costs they'd put in related to phase 2 and phase 3. So this 245 million of assets they have left, that's just the stuff associated with phase 1. So obviously seeing this massive 236 million loss in 2020, and they're seeing this massive drop in assets, that could be alarming. But it doesn't. But looking into it, it doesn't actually really affect anything, because all that this company comes down to is, will they get that deal signed or not before they go broke? So it's kind of immaterial, really. A noteworthy thing here, of course, is the cash and equivalents, which we see getting whistled down, and now they've only got 7 million left in the bank. Now, in the interim report, it's very interesting to look at the going concern section, where they say that they only have 7 million in the bank, and actually they say that if the Falkland Island government asks them to decommission the temporary dock facility they have there, then they'll go broke anyway. Otherwise, presuming that doesn't happen, they've only got enough cash to last 12 months. So that's how I got to the September death date. In the interim report, they also mention how all these things they're doing to save money and scrimp and save. They've had to sublet the London office to gain $1 million. And all of the executive directors have now capped their salaries to 200k. Plus the chairman's took a 15% reduction in his pay, plus another deferred 25% reduction. So with that, the going concern section, and looking at the cash dwindle away here on their balance sheet, we have here the full anatomy of a company going bankrupt. Also add to that the financial director running away. I also noted that they have quite a lot of long-term liabilities in the form of tax payable and deferred tax liability. So I think they can defer the tax payable until they start making money. But then there's this deferred tax liability that they go into in their interim report, where apparently they're in negotiations now with the Falkland Islands government because of Premier Oil walking away. That kind of perhaps means they're going to negotiate it, but apparently they didn't have to pay it until they get their first royalty payments from Sea Line. But it seems from their interim report that they don't have to pay these tax liabilities imminently, but it's still quite nasty to have this 90 million of tax liabilities as well in what is a very, very stressed set of financials. So looking at their equity and valuation profile, and we see here now how small their market cap is against their net assets, and they have a price to book of only 0.3. So this is obviously different, very different to all of the big caps I often look at, but obviously that's because people are pricing in the risk of the company going bankrupt. And when I look at the cash flow, there's no cash coming in, and in the first half only 4.6 million coming out, and so they're down, and so that's where they're going to run out of money this year. With them being an AIM listed company, it was difficult to get much information on their shareholding. RAB Capital and ADOS Advisories have more than 3% of the total holding each, so they are then mentioned in their annual reports and in fact on their website. But otherwise, I couldn't really see who owned any of these. I assume it's mostly institutional, as that normally is the case, but really there's no way of knowing. So not really much useful information I can get for this company in terms of the shareholding. So in terms of oil, the price of oil is obviously very relevant to Rockhopper. And according to the International Energy Agency, demand is set to increase for years to come for oil. As we can see here in their nice graph here, even after COVID, oil demand is set to continue to rise. And of course, we've had this situation where all of the Western governments have been making it as painful as possible for oil companies to operate. And with all these bans on developing oil resources, Joe Biden's pipeline bans and all the rest of it, because of the environmental politics, it's been very difficult for oil companies to develop their resources. But that means that even though the demand's still there, the supply is getting more and more tighter. If you look at the Greta Gold series I did a year ago I did a Greta Gold investment series where I went into all of the ins and outs of this. And I've been fairly confident that oil prices would rise. And they are now approaching record levels. My kind of general expectation is that oil prices are going to remain elevated between $100 and $200 a barrel for quite a few years, because it's going to take all that time for all of the Western governments to change tack and allow the oil companies to start being oil companies again. Plus the actual higher oil price will actually encourage more investment in oil and gas. But it's going to take a long time for all that investment to take place and for the oil and gas resources to be developed. And of course, with the events in Russia recently, all of a sudden now the West understands the importance of oil security, and they're looking to develop more oil themselves rather than import it from Russia. So this actually comes at perfect timing for Rockhopper, because Rockhopper have got properly scoped out and designed for oil assets in their field off the Falklands, which are very easy. It's only 500 meters deep sea. It's very close, very similar to the conditions in the North Sea. So Rockhopper here have got a whole load of oil assets just ready for someone to come in and develop. So with the events in Russia and everything, that's just the little extra bit of news that gives me encouragement, that makes me want to kind of take that risk with these. Because with the situation now in terms of Western oil security, if someone doesn't come along and help Rockhopper develop these fields now, I can't see it ever happening. Also, I should point out that there's a load of oil refineries in the southern coast of the US, which they are looking for a new source of oil, and this is perfectly located for that. This is a very clear-cut situation of this company is going to go bankrupt or have to do a capital raise in 6 months' time. Unless Navitas raise the money and sign a technical agreement in that time, they are going to go broke. However, if these oil fields do get developed, because they do get the money and the deal comes in, the upside is tremendous for this company. And after such a long history where there were all these different operators who were trying to develop the Falklands, and a lot of them drilled duds and had to go bankrupt and turned into zombie companies, Rockhopper were the company that struck oil in the Sea Lion field and were able to develop a proven oil system and set of oil fields that are ready to go. And so just with the recent developments in Russia and the way that the Western companies perhaps are going to value having oil assets within their own territory, and looking at what's happening to the price of oil and its longer term prospects now, I just can't but help take a bet on this one. It's high risk, going broke in 6 months, but high reward according to my calculations. Let's just hope that after such a long and arduous journey, the stars are beginning to align for Rockhopper Exploration. So my verdict is, don't try this at home. I can't resist taking a reckless gamble on this one, but with only a small proportion of what I normally would invest in a stock. There's a high risk that they'll go bankrupt within 6 months or have to do a costly capital raise. However, at least they do have a clear blueprint on future success. They have the Navitas deal there and have a clear route map to success. And the upside from that is 36x from the current market cap based on my calculations. If there's anyone good with the numbers who thinks I'm wrong on that, please do let me know. There is, of course, the Italian arbitration case, which offers us escape route as well if awarded in time. And the recent political situation does actually increase the chances of Rockhopper finding an operator with money, particularly at the current oil prices. This could finally be the moment for Rockhopper after being let down so badly by Premier Oil. Clear and present dangers are the Falkland Islands government asking them to dismantle the temporary docking facility, because if they do, that will blow them out of the water right off the bat. And if the Navitas deal falls through or doesn't happen before the money runs out in 6 months, that's the other clear risk. The action is, don't try this at home.